Welcome back to the Gray Report. Griffin, Haddad, new manager, investor communications here at Gray Capital. How we doing, Griffin? How's your week been? Getting off to a good start. How we feeling?
Week is off to a good start. It's got a nice ring to it. Manager, investor communications.
Yeah.
It's a awesome time to be a part of Gray Capital as we enter into a new year. It's fun to take a look at our team and how we've built it up, how we're projecting the 2026 multifamily forecast for our markets, our target markets, and then specifically across the Midwest. Seems like the next 12 to 18 months could be quite an exciting time, not only to be an owner-operator, but to be a team member at Gray Capital.
Yeah, well, I'm excited for Gray Capital, what we're going to do next year. It's an interesting time to be in the multifamily space, in housing. There's a lot of discussions of revolving around housing and affordability, which brings housing into focus right now. So it's kind of in the national conversation. It's part of the kind of that zeitgeist. And we're kind of right in the thick of it, trying to understand kind of what next year is going to look like. Now, we can look back a year ago at some of the predictions for 2025 and acknowledge that a lot of those predictions and forecasts were not correct. There were calls for a return to like some substantial rent growth this year. I think folks got a little bit over their skis and anticipating a bounce back from slower rent growth as we're seeing supply really fall down, but we still have all of this kind of glut of new inventory. We have all of these new apartment units that just makes it a more competitive environment that while they may be absorbed, they've been absorbed at lower rates, and that has just been dragging things down. In addition to just overall low consumer sentiment. I mean, people are just really just down on the economy, the future. I think the Midwest Multifamily Forecast report that you're one of the authors on, along with John Chapman. My name's on here, but again, it was really you and John that put this thing together. After putting this report together, I'm just curious on some of your overall kind of takeaways, and then we can get into some of the kind of the 5 takeaways that are underlined in the report. But if you have to kind of just step back and kind of give us your take for 2026.
Yeah, I think
what do you see?
Keep flying over the flyover states as people are doing. I think that we've carved out quite a niche as an operator here in the Midwest, specifically in Indiana, Michigan, and Ohio. And I think there's a lot of folks that they take a look at the Midwest markets, and maybe it's simply just not for them. But you'll see in our forecast and even in the Yardi report and the PwC report that we'll look at today, the Midwest continues to outperform the national average, quite quietly. And we're beginning to make a little bit of noise, attracting, allocators from the coast. But at this point in time, I think it's a really awesome and favorable time to be a real estate investor, specifically in the multifamily asset class, with a deep, knowledge of the Midwest markets, and then some kind of relationship with Gray Capital as the sponsor, the manager, the owner-operator, the property manager of these assets. Looking at the Midwest in 2026 and comparative to the nation, you're going to see a lot of deceleration, and that's due to a large supply wave across what would have been the back half of 24 and all of this year. So really that deceleration is just in rent growth. And that doesn't mean we're going negative year over year. It just means we have slower growth. So you'll see, low single digit, rent growth across 2026 in our forecast. And that really is synonymous with a lot of the other forecasts or different predictions that I've been seeing as we put the newsletter together, and I'm reading some of these other predictions. But relative to the Sun Belt, relative to the coastal markets, our deceleration in rent growth, it's actually a little bit more favorable in regards to seeing positive rent growth, just not at the rate that we've seen it in the past.
I mean, it's a good point. I mean, if you go through, some of the markets on an individual basis, kind of isolate it, it can look a little bit negative because it is a lot of like slow growth and really decelerating growth. It's only when you look at kind of the rest of the nation, you see that a lot of these markets in the Midwest are really outperforming all of the other peers across the country. I want to switch to some of these, the takeaways that are in the report and get your opinion on them. And then we'll probably be able to get into some of the individual markets on later episodes. but I think this is probably also a good time to just remind folks that we are hosting a webinar that's going to be doing a deep dive of this report and bringing even more information. It's December 16th at 2 p.m. I believe Eastern. Again, it's going to be a live webinar. So pop on the Great Capital website, greatcapitalllc.com. Not only can you download this report, but you can get registered for the webinar. It's going to be interactive. You can ask questions. These are really well attended and exciting live events. And if you can't make it, sign up for the webinar because then you'll get sent the replay and all of the information. Let's take a look at some of these takeaways. So number one is Midwest leads the nation in sustained rent growth. Midwest remains one of the best performing regions in the United States. And I think, sustained rent growth is the key, one of the key words, I think, in this sentence, because there are other markets and even regions that are, doing pretty well, especially like on the coasts. Like the Northeast has been doing exceptionally well. The markets like San Francisco are posting some really strong numbers in addition. But, a lot of those markets, whether it's, New York or San Francisco, they had, multiple years of negative rent growth.
Yeah.
In San Francisco, while, again, it's been growing a lot, we've reported this on previous episodes, it still hasn't gotten back to like 2019 levels. Whereas the Midwest has been compounding consistently. And while we didn't see the absolute peak, the same high percentages that like Austin saw in 2021, 2022, we saw robust growth. So instead of like 24% rent growth, we had like 14, 15, 16% rent growth, even as high as 20 in some submarkets.
Wow.
But then we never went negative, where Austin has had like negative 20% rent growth over the last 2 years,
Right.
where markets like Indy, Columbus have at least been posting positive, 1 to 4% gains consistently.
Yeah, it seems like our our peaks and our valleys might be a little bit less prominent, but it's smoother ride across the course of an investment period or hold period.
Yeah.
With the steady eddy markets in the Midwest, reducing volatility and allowing for some type of predictability and overall cash flow as we go to underwrite our acquisitions.
Yeah. Number two, slow growth either equals better entry points. Can you explain this for us, Griffin, a little bit? Because slow growth doesn't exactly get me excited to invest in something. But we're saying basically it's going to create some opportunities. What's the deal?
Right. I think if you take a look at overall just purchase price of these assets and whether it's cost price per unit or just the opportunity to buy an asset that continually is going to grow at a steady pace year over year versus an asset that might see a really good initial 2 years, but with some significant deceleration or negative rent growth on the back end, without this really big acceleratory pop when you're buying an asset during that period of growth. Obviously, now your purchase price, your entry point, is going to be much more significant than an asset that has producing 1 to 2% year over year growth. So we just are excited to be able to enter into some of these markets, acquire some of these assets at a purchase price, whether it's per door or just overall purchase price, that is a little bit more advantageous relative to some of these big boom and bust markets.
Yeah, I don't think that people are going to be able to get. I think the slow growth is going to limit some of the some folks being able to kind of bid up some of these assets,
right?
And so in a sense, it's going to have like a short-term ceiling on some of these asset prices. And hopefully allows them to be a more competitive in terms of, folks that are trying to buy it at a decent basis. Because,
great point.
If you only have, if folks are reading, Great Capital's, report, and we're forecasting, for example, just picking let's pick a market at random here. Cincinnati, rent growth's at, 2%. Well, if I can only underwrite, 2% rent growth, or, Louisville at a 0.9% rent growth versus kind of that long-term average of like 3.5%, 4%, I'm not, if I want to hit that 15 IRR over 5 years,
right,
I'm going to have to bid at a lower purchase price. Because if you've ever, really underwritten a multifamily deal, it's all about compounding. We were talking about compounding rent growth, just a second ago. If you have 2% rent growth in the first year, even if you have higher degrees of rent growth in years 3 or 4, it's hard to make up for that lack of growth. So, you're compounding, after it's actually
Year after year after year after
can be
year.
a sneaky trick some sponsors can pull by using like their pro forma numbers in like year one. And so like assuming that you'll have gotten the rent premiums when you buy it to show like, oh, we're showing a stabilized pro forma, even though it's going to take 2 years to achieve
To get
those
there.
stabilized rates. Because then you grow at a 3% rate over those higher rates. You're compounding at the higher rate versus taking a long time to actually get to those stabilized rates and then growing. And so it could be again just some buyers not having the confidence in a lot of growth, so they're either not going to bid at all, or they're just not going to be able to underwrite high returns without a lower purchase price.
Right.
So
Yeah, that's a
hopefully
great point.
folks can take advantage of that. Okay, so now distress will drive 2026 deal flow. Are we sounding like a broken record? I mean, we've been talking about distress. I can remember since kind of 2023. At the end of 2023, there were supposed to be a lot of loan maturities. They got extended. Everyone's pretending that the assets are fine when maybe they're actually underwater. Is 2026 the year where that distress unlocks the deal flow?
I have been seeing whether it's opinion articles or if it's analysis of the amount of distress amongst all the real asset sectors, asset classes. Obviously, pay a little bit more attention to the multifamily, sections of those articles, and everybody is calling for, essentially the buck is coming due. If you have an impending loan maturity or a cap rate expiration, there is no more kicking that proverbial can down the road. And as rates, come down, you would think that distress is being alleviated. But in fact, I think in the last 2 quarters, we've actually seen an uptick in overall distress in multifamily assets. And so with these loan maturities occurring and still the refinance, rates coming down, still assets not being able to cover their DSCR or cover their debt payments, there could be essentially forced sale of assets through operators that can no longer, float the asset. Or we've heard stories from great capital LPs of them pushing GPs out, taking over the asset based on poor management or improper positioning, in the debt market. So it would be interesting to see, especially in the markets that we're operating in, Spencer, if there is truly kind of a fruition of deals that are coming to our table or our acquisitions desk that are in distress or being forced to sell just based on loan maturities.
Yeah, it's been interesting because I think we would have anticipated more, and I think we could see more. It seems like the most distressed deals are being kind of handled not necessarily as publicly. They're not necessarily going to market, but they're being worked out through preferred equity or some sort of like rescue capital. A lot of deals are being recapitalized of where LPs I think just want out of the deal for as much money they can get out of, and a new LP is going to come in and take their spot, and hoping that like, okay, well, we've got a little bit more runway. Also, sponsors don't necessarily want to reduce their AUM, and so you've got LPs that want to cycle out, and usually like a GP like Great Capital, where you're buying and selling. Hopefully you're selling a deal and you're buying 2 deals, or at least you're trying to at least kind of maintain. But right now the deals aren't there to buy, but you do have investors that want to sell. And so as a GP, do you want to see your portfolio be reduced from your 10,000 units down to 7,500 units? And so instead of doing that, of selling it and having it leave the portfolio, because that's a reduction in fee income, management fees and whatnot, they're finding new investors to come in and recapitalize and trade spots with those that first round of LPs.
Right.
And then sometimes in the deals that have seasoned long enough, maybe they were first acquired in 2018 or so, kind of prior to 2020. They weren't purchased at peak 2022 pricing. Some of those cases, those original LPs can actually still make some money, but still have liquidity, get out of the deal, move on to the next one.
You had a conversation with an allocator late last week in regards to them essentially inheriting or having to take over a portfolio of assets, and it might have not been distress or impending loan maturities, but in the event of whether it's a bank, an allocator that is maybe not properly positioned to be an owner operator of a multifamily asset, they're obviously looking to get those assets off their books
Yeah.
to somebody similar to Gray Capital, if not Gray Capital. What do you think about those opportunities? And I know specifically that conversation you had might not have been in the markets that we are focusing in, but as somebody that's looking to acquire multifamily assets in 2026 and beyond, is there an avenue that you can go to a bank, go to the owner operator, the sponsor, the allocator that is not maybe properly positioned to own and manage those assets and seek maybe a portfolio sale or
Yeah.
one or two?
That's a great example. I think some of those opportunities are going to exist. I think some of them are probably percolating up right now. I think they're so far they're kind of few and far between and kind of one-off special situations. But they are definitely popping up more frequently. And that's in that particular example. It's actually a sponsor. I don't have all the details. But speaking to a pretty large allocator, and there are, I think, in about a dozen of these deals with one sponsor. And it is and isn't related to distress, and because there are they're in markets that aren't doing that well. A lot of negative rent growth. It's mostly in the Sun Belt, but the main issue was that there was essentially some allegations of fraud with the sponsor or GP. Essentially misallocating funds, commingling funds, moving improper use or movement of funds is kind of as far as I got into it, and so the JV the allocator, the JV partner, who is typically pretty passive, they're the LP and they've got the sponsor, they've had to step in and essentially kind of remove that GP and are going to be stepping into kind of that asset management role. That's not easy to do. They're not necessarily in the business of doing asset management, or more than asset management, really kind of operating these assets. Even if they've got a third party property manager, I mean, as you can see, you've seen day to day. You can have your property management team, but there's asset management. There's a lot of other lot that goes into it. A lot of decisions, a lot of tracking, a lot of meetings, and a lot of those groups. Not that particular case, but similar. I think they're probably going to make a go of it just because they have to. Because they're probably of the opinion maybe now is not the best time to sell.
Right.
But that in the near future they're going to be looking for exits. Yeah. And so I think there's going to continue to be a lot of kind of one-off situations of where the right deal, being creative, trying to find some solution to come in to assist some of these kind of broken deals. There are going to be some really great opportunities. I don't think you can build a business plan around it just because every situation is a little unique.
Sure.
We explored pretty heavily deploying preferred equity into other sponsors' deals, not our own deals, but other sponsors' deals. And as you were involved in that process, I mean, we spent a lot of effort and time, and we looked at a lot of deals, and we just couldn't find anything we really wanted to put our money into. Yeah. And it's a lot of time, it's a lot of effort. Again, it's few and far between that you really want to participate.
Yeah. I think the idea also, just you mentioned, it's not a business strategy you want to build your entire operations around, but just keeping, we've done a nice job of building a very solid, reliable limited partner equity base here at Gray Capital, and just making certain that your capital coffers per se are full and are ready to be deployed into opportunistic strategies like that. And I think Blake and you do an incredible job of tagging certain investors that have likes and dislikes or would be most interested in a distressed asset. It just would be interesting to see what does pop up in 26, because these broken assets have now been broken for almost 2.5 years.
Yeah. A lot on the new development side too. A lot of nice developments that are now stabilized, but the value that the owner is assigning to it is different from where the market.
And those developers are just not in the business of operating.
They're not. Most of them are not in the business of operating, and they're also not in the business of selling at a loss. But that's kind of the reality that they're facing right now. So that's on for distress. Number 4, supply drops. The supply drop sharpens regional advantage. We've talked about this a decent amount, and I think this theme is throughout the nation. the Midwest has always been moderately supplied. Certainly, we've seen a lot of supply, kind of 40-year peak like other markets. But we are kind of snapping back a little bit quicker, as even like as we'll look at in the Yardi report here in a little bit. There's still a lot of supply coming into a lot of these Sunbelt markets. There's a lot of supply coming into the Midwest still. Again, a fraction of what it was a couple of years ago. But it looks like we'll see at least that the competition recede over time. It's not all happening all at once, as a lot of folks want it to. I think number 5, I think, is an interesting takeaway that we dropped in here that's not necessarily related to the forecasting of rent growth and supply, but it has to do with kind of with costs and expenses come at the end of the day, kind of where net operating income is landing. And that is that the fundamentals are going to strengthen as costs ease. And this is more related to centralization efforts, technology, AI efficiencies, kind of restructuring payroll, but then also some savings that people are finding. And this is certainly an anecdote from Great Capital, but it's not just us. And this is across the industry. A lot of savings on insurance. Insurance increased significantly over the last couple of years, but there is a little bit of a correction. Finally, it's much needed. We're starting to see we're going to be saving, I think, on average, about 30 to 36% on our insurance next year versus what we were spending this year. A lot of property taxes went up across the board. We're getting some of those appeals coming back in, and it just everyone's been forced to be more efficient, and so we're going to start seeing the fruits of that labor in 2026. And so even if there's not going to be necessarily rent growth, we might actually see a reduction in expenses to give us some lift on NOI.
And I think that number 5, you said it's maybe not necessarily encapsulated into our report and our forecast, but it's very anecdotal here at Great Capital. There may be sponsors that are maybe behind the trend in regards to the utilization of technology, the centralization of leasing, all of these different strategies that we are implementing here at Great Capital to really drive bottom line and push investor returns in a more favorable way. So number 5, maybe not necessarily directly tied to what's included in the report, but somewhat of a sneak peek window into our operations at Great Capital into the next year.
Yeah, 100%. Well, just a reminder, you can go grab this report, greatcapitalllc.com. It's the 2026 Midwest Multifamily Forecast Report. It's packed full of insights, again, forecasts on rent growth, supply for some of the Midwest's top markets. So if you're at all curious about the Midwest, check it out, greatcapitalllc.com. You'll find the link, and then make sure you register for the webinar as well. I want to shift over to talk about this PwC report. Do you have something else?
We definitely got to let everybody know that data scientist John Chapman will be on the webinar, diving into methodology, data collection, aggregation, John's a gem of a human. So tune in, 1, to meet John, 2, to understand his methodology, and 3, to dive deeper into the report with Spencer. It should be a great webinar. Don't miss it.
Yeah, it's gonna be a lot of fun. Yeah, because this was not just metrics that we pulled from CoStar. We use CoStar, as a lot of kind of the source for a lot of the data. But as you go down to the bottom of a report and you read the methodology, there was a lot of kind of custom
modeling
that was done. Use a lot of machine learning for a lot of these, a lot of the forecasts. So really, really just proud of the team, of the work that you and John did to put this report together. Some really novel research, and be on the lookout for more from the team.
I did not draw those images.
Oh, don't give all your secrets away, Griffin. I thought you
did not draw.
Spend your extra time with these great looking images. I thought that you did a great job.
Yeah, they're awesome.
I can just see you there in the wee hours of the morning with your
charcoal.
Yeah, your pencils.